Welcome back to Seed to Wealth. Today, we are looking at the single most important earnings report for the healthcare sector, UnitedHealth Group. If you are new to investing, looking at an earnings report like this can feel like reading a foreign language. You see billions in revenue, strange accounting terms, and mixed signals where some numbers go up while others crash down. But don't worry. My job is to translate this Wall Street jargon into plain English so you can understand exactly what is happening to your money. United Health just released a report that is confusing a lot of people. They made more money than ever before, yet their profits are shrinking, and they are planning to lose millions of customers on purpose next year. Is this a disaster in the making or a genius turnaround plan? We are going to walk through this report image by image to uncover the truth. I'm Zuhair. Let's get into the numbers. Let's start with the big picture, the headline numbers. Think of these as the score at the end of a game. They tell you who won, but not how they played. United Health reported full-year revenues of $447.6 billion. To give you some context on how massive that is higher than the GDP of many countries. That revenue is up 12% compared to last year, which usually sounds great. If you owned a lemonade stand and sold 12% more lemonade, you'd be happy, right? But here's the catch for beginners. Revenue is just the money coming in the door. It doesn't tell you what stays in your pocket. They also reported adjusted earnings per share of $16.35. That word adjusted is a huge red flag we need to talk about. It means they took their real profit number and added back some one-time expenses to make it look better. They want you to focus on this pretty number, but as smart investors, we need to know what they are adjusting out. This brings us to our second image, and this is where the ugly truth comes out. Remember how I said they adjusted the numbers? This table shows you exactly what they swept under the rug. In early 2024, United Health suffered a massive cyber attack on their Change Healthcare unit. It was a disaster. You can see right here that the final cost of fixing that mess was $799 million. That is nearly $1 billion just to fix a hack. But look at the line below it. $2.5 billion for restructuring. What does that mean? In plain English, restructuring means the company realized it was bloated and inefficient. They spent $2.5 billion firing people, closing down offices, and exiting bad business deals. When you add it all up, that is nearly $3 billion in losses that they are trying to tell us don't count towards their normal business. But that is real money that left the building, and it explains why their actual bank account doesn't look as good as their adjusted earnings suggest. Now, let's look at this chart because it teaches a perfect lesson for beginner investors. Bigger isn't always better. Look at the bar chart on the left. That shows revenue climbing steadily, up 12%. That looks like a growth stock, right? But now look at the chart on the right. Earnings from operations. In the fourth quarter, their actual profit from running the business collapsed by 41%. How can you sell 12% more product but make 40% less profit? Imagine you sell t-shirts for $10. Last year it cost you $5 to make one, so you kept $5. This year you sold way more shirts, but the cost of cotton doubled, so it cost you $9.50 to make one. You are selling more, but you are keeping almost nothing. That is exactly what is happening here. Their cost of goods sold, which in healthcare means paying for doctor visits and surgeries, exploded. They grew the top line, revenue, but destroyed the bottom line, profit. This next image highlights the most critical number in the entire insurance industry, the medical care ratio, MCR. You see it here at 89.1%. For a beginner, think of MCR as the payout percentage. If you pay United Health $100 a month for insurance, MCR tells you how much of that money they have to turn around and pay to your doctor. In the past, this number was usually around 85%. That meant for every $100 they collected, they kept $15 to pay their staff and keep as profit. Now, that number has jumped to roughly $89. That leaves them with only $11 to cover all their overhead, technology, and salaries. A jump from 85% to 89% might sound small. It's just 4%. But when you operate on razor-thin margins with billions of dollars, that small jump wipes out billions in profit. This proves that Americans are getting sick and going to the doctor much more than the insurance company predicted. So, how do they fix this broken profit machine? This image reveals their radical strategy for next year. Look at the people served column. They are forecasting a contraction. That means a decrease of between 2.2 million and 2.8 million members. This is shocking. Usually companies brag about gaining customers. UnitedHealth is telling us they plan to lose nearly 3 million customers on purpose. This is what we call a shrink to grow strategy. They realized that millions of their customers, likely on Medicaid or bad Medicare Advantage plans, were costing them too much money. Remember that high MCR we talked about? The only way to lower it is to kick out the customers who are getting sick the most and paying the least. They are firing their unprofitable customers. It's a painful move that hurts their size, but it is absolutely necessary to save their profit margins. They are choosing quality of revenue over quantity of revenue. Next, let's look at Optum. For those who don't know, UnitedHealth isn't just an insurance company. They also own Optum, which is a massive technology and services company that manages pharmacy benefits and data. Usually, Optum is the golden child. It's the steady, high-profit part of the business that saves the day when insurance gets rocky. But look at this chart. Optum's earnings fell off a cliff in the fourth quarter. Why? Because the cyber attack we talked about earlier specifically targeted the Change Healthcare unit, which lives inside Optum. When the system got hacked, they couldn't process payments for hospitals and pharmacies across the country. They had to pause business, lend money to doctors, and spend a fortune fixing the code. This chart shows us that there was nowhere to hide. Both the insurance side, UnitedHealthcare, and the services side, Optum, took massive hits this year. The safe part of the business wasn't safe at all. Now we have a quote from the chairman, Stephen Hemsley. He says, "We confronted challenges directly and laid the foundation for more disciplined operations." Investing isn't just about math, it's about psychology. You have to learn to read between the lines of CEO speak. When a CEO talks about confronting challenges and laying a foundation, they are admitting that the current year was a disaster. They are basically saying, we know 2025 was messy, we know we lost money, but we cleaned up the mess. He is trying to tell investors that all those billions in restructuring costs were necessary to fix the company's discipline. He is asking for forgiveness for 2025 and asking for trust for 2026. This quote is their way of putting a period on the end of a bad sentence and trying to turn the page to a new chapter. Here is the outlook for next year, 2026. And this number is very rare to see. Look at the revenue guidance, $439 billion. Wait a minute. Didn't we just say they made $447 billion in 2025? Yes, we did. That means they are forecasting their revenue to drop by about $8 billion next year. For a beginner, a company saying we will make less money next year usually sounds like a sell signal. But in this specific context, it confirms their strategy. Remember, they are cutting 3 million members. If you fire customers, you lose their revenue. This proves they are serious about the shrink to grow plan. They are voluntarily giving up $8 billion in empty calorie revenue, money that looks good on paper but generates no profit, in hopes that the remaining $439 billion will actually be profitable. It's a bold, disciplined move that prioritizes shareholders over vanity metrics. Now, if all this sounds scary, here's the image that should help you sleep at night. This is the cash flow statement. Accounting earnings can be manipulated with write-offs and adjustments, but cash flow is real. It's the actual cash entering the bank account. Despite the hacks, the restructuring, and the lost profits, look at that number. $19.7 billion in cash flow from operations. That is 1.5 times their net income. This is the company's safety net. It means that even when they are losing money on paper due to accounting rules, their business is practically a printing press for cash. This massive pile of cash is what allows them to keep paying you dividends and buying back their own stock, which supports the share price. As long as this number stays high, the company is not in danger of going bankrupt. It is a fortress that can survive a bad year. Finally, let's look at the target for next year. This is the light at the end of the tunnel. Management is guiding for adjusted earnings per share of greater than $17.75. Remember, this year, 2025, they hit $16.35. So despite shrinking revenue and losing customers, they expect their profit per share to grow significantly by nearly 9%. If you are a beginner looking for a buy signal, this is the number to watch. if they can actually pull this off. If they can cut the fat, fix the margins, and hit 17.75, then the stock is likely trading at a discount right now. They are basically promising us that for every share of stock you own, they will generate nearly $18 in profit next year. That is a very healthy number. It tells us that if the shrink to grow surgery works, the patient is going to be stronger than ever in 2026. So that is the reality of UnitedHealth Group's Great Reset. It's a messy, complicated report, but now you understand the story behind the numbers. They are taking the painful medicine now, paying billions to fix hacks and firing unprofitable customers so they can be a leaner, more profitable machine in the future. It's a risky pivot, but for a long-term investor, seeing a company prioritize profit over blind growth is usually a good sign. If you found value in this deep dive, please hit that like button and subscribe to Seed to Wealth for more honest financial analysis. I'm Zuhair, and I'll see you in the next one.